Hi all, welcome to the 12th episode of Day Trading Explained series. We're getting closer to the finale, which is the targeted 14 chapters. I already know that we won't be able to accomplish all our missions in only 14 chapters, but we'll add some chapters as needed after. Let's get into a super important part of the puzzle for traders, day traders, long-term traders, basically anybody that's in the business of stocks, forex, anything that's a financial instrument, and it is technical patterns. In front of you guys you see a bunch of technical patterns, and you can see here an ascending triangle, a descending triangle, a symmetrical triangle, symmetrical triangle short, a descending triangle of course short, and an ascending triangle. Now if you Google technical patterns, there is a growing number of patterns that are evolving, and basically they totally are totally showing what can happen in a certain scenario. But of course, being that we observed, or most of us that day trade observed charts for many years, we know that this is the theory, and then there is the real life. So in theory, when you are in a simulator, you may see a descending triangle like the one that's posted here, this beautiful one, and this beautiful one, ascending triangle. We don't see them very often in real life. Okay, we don't see them very often. It's possible that they are appearing 20 times a day in various stocks or instruments, but keep in mind there are thousands of instruments. What are the chances that you're gonna see the ascending triangle when you're looking actually at a different instrument? And what are the chances the ascending triangle is an instrument that you're actually worth trading? Maybe this is a, I don't know, a spready stock, a low volume stock, a stock that's going to move up 0.5% and then drop, because of course you don't see you see only the before picture, you don't see what's happening after. Having said that, as the day traders, we totally depend on technical patterns. But before we look at technical patterns, we need to find, and this is I hope by now clear, we need to find the right stock to trade. So we're not looking at the technical pattern, we're looking first at the right stock to trade, and then we're trying to apply the technical pattern to the chart that's in front of us. And if the chart in front of us is, let's put it this way, enough for us or giving us enough forensic evidence to take the trade, then we can do it, and if it fits a technical pattern, so be it. But again, technical analysis is part of being a day trader, is super important, but it's not the most important part. The most important part is the step towards the trade, and the step towards the trade involves also technical analysis. But before technical analysis, you're looking at the market, then you're looking at the potential stocks. In front of you have those 16 stocks that we called long screen from Thursday, half a trading day. So there are 16 stocks, so some of them are up already 130%, others are up only 7%. Amongst those stocks there will be those that will show us technical patterns, and technical patterns should show us support and resistance levels, entry points, stop losses, how we can fit our strategy. Especially for day traders, we want to manage risk very carefully, because as a day trader, this is actually the part where you contribute the most. Finding the right entry, and then if the stock works against you, trying to exit with a minimal loss. That's super important. And it's also important how you manage the trade, but this is far less important because you don't need to manage that much. Okay, but you need to manage your risk, And if you're not a great day trader and you take 5 trades per day and each trade doesn't lose more than 1% or even less on average, you can still get you can still be profitable with one good trade. So you don't need to be a sharpshooter, but you need to be a great risk manager. Okay, so those patterns are helping us reach better decisions, and there are so many technical patterns. Let's take a look at another one. Hold on a second. Okay. Okay, so we have this probably the best, in my experience, the most coveted by me at least, the cup and handle breakout, or even better, reversal, where breakout is at the highs of the day and reversal is somewhere below the highs of the day, but still with the trend, which in this case is obviously long. So in this example, this is the buy point. You buy here at the breakout higher, and the stock moves higher and you make money, and that applies to all time frames. It can be a forex play, a Bitcoin play, a futures play, a stock play. Any time frame fits this cup and handle lab rat experiment. But you can check me, go and look at 100 stocks if you have the time, daily, intraday, forex, and see how many times you see this perfect pattern. This is of course an absolute perfect pattern, but you won't see them very often, and sometimes you will see them but not in the right instrument, so the trade may fail, or the risk, which is defined by this handle. Okay, so this is the risk on the trade where the entry is here, is I don't know, unreasonable. Maybe it's 100 pips or 500 pips. Maybe it is 3% versus the target of, I don't know, 5, which doesn't make a lot of sense. Bottom line is that we need to look at the whole picture. So therefore we cannot look at the standalone technical pattern, not to mention standalone intraday bars. Those are ridiculous. We want to see patterns that develop over time. And why is that? Because we need time to prepare to enter the trade. We're not going to enter hastily in a trade without assessing the risk, the stop loss, and the target. That takes time. Okay, so in order for us to acknowledge the trade, assess the risk, enter the position, and think about how it's going to manage, or how we're going to manage it. That's a process. So in order to enter a trade, we need anywhere between 5 and half an hour. So if the pattern spreads over half an hour intraday, it can be an amazing pattern. Okay, and we have the tools to enter any pattern, even if we need to wait 45 minutes or an hour. I know it's not reasonable for day trading, but it can happen from time to time. Okay, now let's take a look at real life patterns from not from 5 years ago, not from 3 days ago, from the last trading day. Let's take a look at AOI. We've seen this stock many times. Okay, and this is now the 1 minute bar, so you can see the price action very clearly. So what kind of patterns are here? Or do we see here? We see a kind of a bull flag formation. Remember this name? I didn't show it to you here, but you can Google or go to Investopedia and see the bull flag formation. Is it a perfect bull flag? No, it isn't. But what does this pattern show us? Okay, and it takes 1, 2, 3, 4, 5, nearly 10 minutes, a little bit more. It shows us the high of the day, which is a round number. We know already that we love round numbers, and it shows us, that's the most important thing, the stop loss. And if the stop loss is, according to our plan, less than 1%, we can take the trade and assume the risk, which is according to the chart. It's not like made up by me or anybody else. Now some people will say, okay, it's not a perfect stop loss. Maybe the stop loss is at the VWAP. And this is an 80-cent stop loss. Okay, so if you think that the stop loss is at the VWAP, let's say it is 80 cents, you cannot take this trade and risk 4% on AOI breakout over the highs. Because if you risk 4%, it means that you will need the stock to move up 8%. Indeed, it moves 10%, but it's unreasonable to think about it. Okay, so again, you look at the chart, what's in front of you, assess the risk. Now, if you are risk savvy, you want to take more risk, there are two ways to deal with that. You can increase your stop losses or buy more in a position. So instead of buying, let's say, $10,000, buy $200,000. That's another way of increasing risk on the same position. So you can increase risk by buying more or by lowering your stop loss and letting things happen. Okay, we as day traders want to take less risk. That's the first goal. Take less risk and let the market do the job for us. Now, why we want the market to do the job for us? Because we already did the homework, and we are looking at the only 16 stocks out of 6,000 that are probably the best suited to move higher. Probably. Obviously, it's not the case, but they have at least the intrinsic power to move higher. Some of them are up 7, some of them are up 100%. Obviously, we're not looking at stocks that are not moving at all or moving lower, and we're thinking, yeah, they're going to start moving higher. Why? Because, I don't know, we decided. So, we did our homework. Now we need to act based on our homework that we did, and we want to take lesser risk, and now we need to manage the trade. But technical analysis is helping us to a certain degree. For example, we can see that the stock is moving higher. Let me point it out. Is moving higher and higher and comes back to this level, which is what can be basically an exit point later. And then from this level it shoots higher. So this level, which is now, let me see the real number on the chart, it's 29.42, let's call it 29.50, will be the stop loss if I want to elevate the stop loss from the entry to into the money. While the stock is now trading at 30.40, comes down to this 29.50, and it's now at 31. Let's say that now the stock is at 31. Where should my stop loss be? One of the options is here. Why? We see this small pullback on this wick here. Now others will say, no, you need to elevate it more to 30. I think that's right. In retrospect, the stop loss could have been elevated to 30. Having said that, our strategy is to let the trade grow, and sometimes the trades will grow, and sometimes the trades will retreat, and this one is really a nasty one where if you want it to grow a lot, basically you lose all the profits. So it comes back to the entry, which is doesn't happen very often, where a stock is up 8% or whatever it's here like, yeah, almost 10%, and gives up on all those profits. Doesn't happen very often, but you can see on this example it can happen. So how does technical analysis help us? It helps us with the entry point, with the stop loss, with the risk, with managing the trade. So in the whole complex of day trading, technical analysis is a super important part, but it's not the most important part. The most important part is finding first the right stocks that will give you the opportunity to see a move intraday of 10%. 99.99% of the stocks Thursday, when this trading day occurred, won't give you the chance to move 10% intraday and show you a clear entry point. Okay guys, it was very, very short. We'll continue on that in our next video, which will be video number 13 of this series.